Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Good morning, Ben.
Hi, Will. How are you?
I'm doing pretty well. So we both had busy weekends. We were up in Kalahari here in Ohio, both going to the Young Ag Professionals Conference hosted by Ohio Farm Bureau. So it was a really good networking conference. A lot of good sessions. Ben, you had a couple of really good sessions. So it was a good
Thanks,
week.
Will. Yeah, thanks. Appreciate it. It's fun. I enjoy going and seeing friends and just networking. I think the benefit of those isn't coming to hear me or others speak. I'm not discounting any of the other speakers, but it's truly networking, right? Like getting the opportunity to meet other people that are working in farm, ranching, ag. It's a great opportunity.
Although I found here in Ohio, you use the word ranching and people kind of chuckle at you. They don't really say that out here, I guess.
That's true. That's true. Their cattle industry has lush green grass, not like us out here in the Western Plains. So
But anyway, like you said, it's a really good networking event. So I'd encourage any young ag professionals get involved in state organizations and get those connections built out. It's really good long term, can't hurt, and it's good to have friends in the ag industry. So, looking at the markets, what kind of adjustments have we seen coming in from last week?
absolutely. And I want to start off and say last week we talked about how soybeans didn't like the air above 15 bucks for old crop soybeans. They proved me wrong this week. We basically spent the entire week above $15. So I'm going to start in the soybean complex. So old crop soybeans up 40 cents this week to trade, or up, yeah, 40 cents on week over week to trade at 15.30 on the close on Monday. New crop soybeans up 23 cents to 13.62. Old crop corn up 14 cents to 6.80. New crop corn up 2 cents to 5.88. Old crop wheat for March up 23 cents to 7.43. New crop wheat up 24 cents to 7.54. That West Texas Intermediate crude oil was down $4 a barrel to $77.65.
So, really looking at some adjustments on there. What's been really driving the market in the past few days?
Yeah, I've just got a couple of highlights here. U.S. crude oil, gasoline, and ethanol stocks all increased last week, while distillate stocks were down. Gasoline demand was slightly up on the week, but still remains 4% below where we were, even last year at this time. Ethanol production was up slightly, but still below 300 million gallons on the week. It was another decent week for agriculture export sales. Soybean sales continue to set a counter-seasonal move, increasing week over week. Again, China represented about 83% of those new sales this week for the current marketing year. Corn sales were down week over week, but above their 4-week average, thanks to strong purchases from Mexico. Open interest positions were up across the board for Chicago wheats, corn, and soybeans. Managed money positions were up for the feed grains and down for soybeans. On the agriculture export front, soybeans continue to show strength with 68.2 million bushels shipped last week. Wheat was also strong at 16.4 million bushels. Corn shipments were relatively soft, and that deficit continues to grow. So that's our week, Will.
Yeah, well, it's kind of like on the trade front there, seeing some support from China in the soybean category, like your counterpart on the livestock side, Scott Brown says, if you're not sure what's going on, most of the time the answer is China. So
That's a good economic answer. That'll at least give you an 80% on most ag econ tests. So
exactly. So looking at today's topic, we're going to be looking towards South America, seeing some crop expectation adjustments there. Brazil, we're seeing some raising expectations. Argentina, maybe a little bit lower. So as we kind of see these adjustments on the spreadsheets, what does that mean for overall demand when you see kind of a bump up in one South American country and a drop in another?
So the condition is bad in Argentina. And growing worse. Very dry conditions, 40-year, drought, historical drought, basically, and that condition continues to impact, crops in that South American country. The story in Brazil is really just the sheer size of acreage, right? They're gonna be up likely on yield unless a catastrophic outbreak of pests or hail, you name it, that impacts the entire country happens. They're going to have a solid yield, not record breaking, but a solid yield on certainly a large amount of acres, and so that's kind of the counter here is Argentina is struggling on the yield side. Brazil is maintaining, at least a decent yield, just with large acreage. And as a result, we're probably going to see soybeans flow out of Brazil down the Panera into Argentina, and that's, I think, why we're seeing China come back into the market, buy some soybeans at this time of the year from the United States, to get some soybeans on the books, just in case Brazil doesn't have those available supplies because they're shipping them to Argentina or other things. So I do think that we are seeing a little bit of an extension here, to our export sales window, in the United States as a result of the weather challenges in South America, and that's certainly helping the soybean market.
Well, I know we've been talking about this the last few weeks, talking about the struggles on the U.S. export front, and really, something like this, it is a positive. But how much sustainability do you think this type of trade has? Whenever it seems to be just, safety buying from China's front.
Yeah, good question. So we've seen struggles in the export market in the feed grains, relative to expectations. The soybean oil market has been relatively strong, and in fact, I think a lot of people would anticipate USDA to maybe look again at that soybean export number again here in February and March, because we've seen such strong sales and strong soybean shipments that maybe USDA was a little bit over aggressive or early maybe in making that soybean export revision in in January. Now that revision was largely because we had a mammoth crop in Brazil. And I think that all kind of tied together. And certainly I think we're going to see those supplies come to market. But we're still seeing some buyers for our market. The US dollar has come down, and that certainly helps bring people back into our market as well. So I think for the time being, this is demand that's here for however long we can have it. And certainly that's good. It's really an extension of our export season. I do anticipate, if you look at cash prices, Brazil is still more competitive into the Chinese market than the United States. So I do still anticipate that we're going to reach a period of time where those purchases shift primarily to South America, away from the United States. So maybe a temporary blip here, as we look ahead.
So talking about the difference in cash price there, how big of a split, if you have that in front of you, how big is that?
I don't have that in front of me.
Putting you on the spot. I'm sorry.
Yeah, I don't have that in front of me. Let's just say it is cheaper, for South American soybeans, even with transportation costs, to get into the Chinese market. I looked at that yesterday, but I don't have that in front of me.
Yeah. So talking about an extension of that trade window here in the U.S., do you have an idea of maybe how much of an extension that might give U.S. farmers to market some grain?
I would say primarily, 2 weeks here in February. I think we're going to continue to see, the U.S. be competitive in the export market on the soybean side, maybe even through the month of February. So maybe over the next week to three, as we look ahead. But certainly, this is helping support some of these higher prices we're seeing in the soybean market.
Yeah, like you said, seeing the soybean sustained over $15 last week. So really, outside of the trade market, talking about, maybe some early expectations. We're just about to turn the calendar into February. At what point do we start seeing some planting expectations in the U.S. start driving a little bit of market adjustment?
Absolutely. Really, I don't think that discussion really starts to come until we get through February. A couple of reasons for that. One, February is the month where we set the harvest or the projected price for crop insurance for both corn and soybeans. So I think we got to get through that first, to really set some of those early planting expectations. But really, I think the market's going to start focusing on acreage, in the lead up to the March prospective plantings report, which comes at the end of March. And so maybe like around the 15th of March is when we maybe start to see planting or at least those expectations of planted acres start to become a bigger part of the market here in the United States, the futures market. But for right now, it's all demand driven. And specifically related to our competition around the world.
So really, as we look ahead the rest of this week, we've had some big report weeks the last couple of weeks, but what should farmers and ranchers really be paying attention to as we go through the first week in February?
Absolutely. So here, just a little bit later today, we're going to get those state storage reports. These are kind of our indication of that winter wheat crop across the plains, as we don't have weekly crop progress reports. That's how we get this information. It's also kind of an interesting week as we turn into February. We get monthly grain crushing and oilseed crushing reports on Wednesday. We'll have our normal ethanol report on Wednesday, and then Wednesday afternoon is the announcement from the Federal Reserve in terms of any changes that they're going to make to that short-term interest rate. The market's currently anticipating a quarter-point interest rate, and I anticipate that's what they'll do. That's kind of what they signaled so far. But probably more important will be their comments about future interest rate hikes as we look ahead. And that could impact the market, even in the commodity sector as well. Thursday, export sales, and then Friday, commitment of traders. So a couple of normal reports sprinkled in amongst some unique reports for the week.
Just a quick note on the Federal Reserve. What are your thoughts? Have you been surprised, or has this been pretty much in line with the expectations on the timeline that the Fed's been, slowly bumping up interest rates?
Yeah, so this could be a whole webinar, Will. I have lots of thoughts. Yeah, okay, so I'll try to synthesize this really quick. The Federal Reserve has, over the last couple of years, has focused on transparency and being transparent with the market. They have basically signaled through communication channels what they plan to do, whether that's a quarter, whether that's half, whether that's a 3/4 of an interest rate hike. They have signaled to us that for about 2 years now, and they have always followed through with what they have signaled to do, and that has come at a shock to basically Wall Street, traders on Wall Street. They have repeatedly not believed that the Federal Reserve has been committed to increasing interest rates to help fight inflation. And as a result, the market continues to be shocked when the Federal Reserve comes out and says, yep, we're gonna go another 50% or 50 basis points or 3/4 basis points or 25 basis points next month, right? And the market is shocked by that because they're ready for interest rate cuts. Wall Street benefits on decreasing interest rates. But certainly the Federal Reserve is trying to fight inflation. My personal thought, this isn't the thought of the University of Missouri or Brownfield, I probably should clarify that, is the Federal Reserve is whacking the demand for goods. Higher interest rates are increasing, those rates that people use to buy cars, to pay on credit card bills, stuff like that. And as a result, we have seen demand for goods, electronics, other consumer products continue to decline. So it's working. The higher interest rates are working to slow down goods. The problem is the inflation we're seeing is on the labor side, on the wage front, and that's a whole different beast to fight. So I encourage people to think about and separate. We are a service-based economy, and we are seeing that lead some of our inflation numbers at the moment. The good stuff is being corrected. The Fed's done their job on that side, in my opinion, but the wage side's hard to fight. So that was an extra 5-minute spiel, Will. I'm sorry, but just had to get that out of the way.
Well, like you said, we could spend a whole episode on this.
It feels good to get that off my shoulders. Yeah, it feels good.
Yeah. But it's kind of funny, it's like you talk about the Fed signaling what they're going to do and following through with that, and that shocking Wall Street. It reminds me of something. I don't know how many people out here have watched the Pirates of the Caribbean, but there's a part in there where like, he lied to us by telling us the truth. So. Gotcha.
They've been transparent. This has been kind of their policy position for 2 years now. Is we are going to be transparent to the market. The problem is the market's not believing what they're saying. So it's an interesting dilemma.
No, for sure. So, looking to close out this week. If viewers, listeners, if you'd like to learn more about what we do or about our sister program, the weekly livestock market update, you can do so at brownfieldagnews.com. Ben, it's always a pleasure to have you on here. I appreciate your time. I'm Will Robinson on Brownfield.